Thanks, Marty. Welcome to IvyFON Silicon Valley Family Office Summit. Today, we are talking about FinTech in 2020 and beyond. Thank you to Marty for organizing this, the participants, and the panelists. FinTech. Recently, I was browsing some news, and I came across a little blurb. A manager of a corporation asked his engineer, "We need to build a blockchain to innovate this business." And then Dilbert replies, "What color do you want it?" And then I saw another cartoon. Two guys on a horse see a car pop away, and they go, "I can't wait for this bubble to pop. This car fat has just no legs." Now, that's where we are here, I think, about FinTech. Just as I'm sure that there are pointy-haired bosses who are raving about their purple blockchains, there are a few guys standing next to a highway going, "Boy, I can't wait for this car valuations to go down to zero." So we're here with a group of sharp and experienced investors and practitioners covering a diverse set of areas in FinTech. And we're going to help us distinguish the hype from the reality and share some of their enthusiasm about what's exciting in FinTech and beyond. Our first guest is Tom George. Tom is the president and managing partner in real estate and franchise at Perseus Group and with Constellation Software, a holding company, which acquires software businesses. Before joining Perseus, Tom held executive roles across a wide variety of companies, including Move, a real estate website, Broadband Office, a telecom carrier, and Accenture. Tom, would you mind taking a couple of minutes to introduce yourself and talk a little bit about the developments in real estate tech?
Yeah, sure. Well, thanks for having me. It's always great to be able to speak at Marty's events. Constellation Software is a publicly traded holding company that is around $5 billion in revenue and holds for the long-term portfolios of vertical market software companies across over 100 industries. The area I focus and the portfolio that I manage is all real estate focused. There is a lot of FinTech buried in real estate because it is typically the largest transaction most people have in their lives. We have acquired over 20 businesses, most focused in residential real estate, serving real estate agents and brokers and multiple listing services and franchises. And more recently, acquired a mortgage loan origination software business, which is really marrying the real estate part of the transaction and the mortgage part of the transaction. A lot has been going on in residential real estate, accelerated by the pandemic, both in terms of the professional customers' usage of our technologies to meet and consummate buyers and transactions. And a lot's been happening with consumers and homeowners. The CEO of Zillow called the recent migration patterns the great reshuffling. Folks are moving to 15-minute cities where they can get around more easily than you can here in Los Angeles, where I am, and working, remotely in much greater numbers than we've ever seen, before the last 2 years. And as Marty mentioned earlier, all of this accelerated usage has contributed to pretty incredible valuations. You had what's now called ICE Mortgage, pay $11 billion for Ellie Mae, which had only been purchased 15 months before by Thoma Bravo for around $4 billion. And the list goes on and on. So it's an exciting place to be. It's challenging to get acquisitions and not feel like you're overpaying. But there's certainly lots of growth, and COVID has only accelerated that.
That's great. Thank you, Tom. I think this is a pretty unique and interesting area to kind of for us to delve into. And next we have Ravi Bhatia, who is the principal and CIO at Verano Capital Partners and manages a long-short equity fund for the technology sector. He has a passion for global markets and economies, but also keeps a pulse on the local action. His strategy spans fundamental, economic, and behavioral analysis to for strategic and tactical asset allocation. He has an extensive Big Four and Fortune 500 background in business advisory, transformation, and corporate development. In addition, he also has worked with SMBs and early stage ventures in healthcare and biotech. Financial services is amongst one of the verticals that he focuses on alongside of tech, consumer retail, and healthcare. He thrives on social impact, sustainability, and health and wellness. He's involved in TSC Water Security Fund, and I'm very interested in learning. So Ravi, a little bit more about it. So Ravi, if you wouldn't mind taking a minute to introduce yourself and what you're excited about in fintech and particularly its ESG dimensions.
Yeah, thank you, Manish, for the introduction, and thanks, Marty, for having me on the panel. It's a pleasure to be here, and certainly I think we're in a very interesting time throughout the globe, not just in the US, just because of the climate changes that we've been experiencing. And that kind of goes segue into the social impact, sustainability, and the entire ESG component. So, you know, based on my investment background and experience in the technology sector, which kind of helped me a little bit, you know, pivot into the financial services side and fintech. And fintech, as we all know, has been growing leaps and bounds from, you know, last 5 years. And I think COVID basically accelerated the growth of, you know, the different areas of fintech, from the banking side to investments and payment services and so on and so forth. So just to give you a quick some numbers on this, the global fintech startups raised about 31 billion in venture funding to surpass the Q2 2018 record, which is just crazy number for just, you know, this year alone. And the overall exits in the VC have been over $134 billion in total value created than the industry has combined to record in the past 7 years. So the, you know, the trend towards fully autonomous fintech is ushering in new applications as fintech startups sort of focus on the, you know, the areas of corporate treasury functions and beyond that. The area that I like to kind of focus on is the green finance. The green finance is increasingly gaining attention around the world as an important way for basically meeting the needs of environmentalism, capitalism, and the social consciousness. The fintech market in the green space is green fintech is set to be about $500 billion US by 2025, which is a pretty remarkable number if you think about it, the amount of wealth that's been created since post-pandemic and where we are today. Obviously, the political, demographic, and regulatory influences have encouraged companies to look at green fintech a lot more. And millennials and Gen Z are the primary users of green fintech. So they are the ones that are really concerned about the social cause, the environmental issues, the corporate governance, and that's sort of pushing this growth. And even you know, looking at companies, how they are monitoring their global you know, usage of energy and energy production. So one particular area that I would say is a focus that I want to kind of focus on is as I'm pivoting into another area, which is the water-based index. This is an index started by my colleague, Thomas Schulman. I believe there should be a handout that should be passed around. And essentially what he's done is he's created a water index to mirror the S&P in terms of how globally companies are using water, which is really basically the water, you know, consumption, water, you know, refinement, water utilization, and water is basically the single most greatest opportunity because the earth is 80% water or 75% for that matter. And this is an area where we are looking at creating, changes through basically making companies responsible, socially, govern themselves on, water usage and water consumption. And I think overall, one of the bigger companies, investment companies in the world, when it comes to the sustainability and impact. And we feel that water, index, which will pretty much, I would say, in the next 3 to 5 years, will essentially take on a much bigger role as a climate. This is the single largest social, environmental, financial risk that we have. And the way we're going about possibly looking at this is that there are a lot of challenges to be had, but more importantly, I think the awareness has to happen now. And the capital raise for this type of a investment vehicle can happen through multiple ways, but tokenization is one of the ways. And that as we go along in this panel about how water can become the basically like a water token, how solar has become in the solar industry as a solar coin. There could be a water coin potentially, which will change how we can invest in, do impact investing in these type of actions. So,
hey, Ravi, you're kind of freezing up some. I don't know if you're on Wi-Fi or not, but
yes, I am.
So if you're freezing up, you may want to just turn off the video and just speak.
Okay.
Yeah.
Okay. All right.
Thank you, Ravi. And we'll definitely come back to those ESG aspects and some of the demographic shifts that you alluded to earlier. And now Joe Sanchis. Joe is the founder of GammaRay Ventures. He's a serial entrepreneur. He has led led to the successful development of fintech platforms for Wall Street firms and institutional alternative assets, finance, and cryptocurrency startups. He's previously held executive positions at Morgan Stanley, Wells Fargo, JP Morgan, and in a number of venture capital and consulting firms. Joe was recognized as an innovator of systematic virality by CIO magazine in 2017, and as a young professional leader by the US Senate in 2006. He's passionate about economic equity, market access, small and medium business growth, and democratization of finance. Joe, please tell us a little bit about your interests and what excites you here.
Great. Thank you, Manish, and thank you, Marty, for having me. Again, my theme in my career is really about how to utilize financial innovation so it could be more accessible for more firms and more people. And so this democratization has been occurring and obviously accelerating in recent times. The areas that I'm really passionate and focused on right now is in a few main areas. One I call online capital markets. And I think this is one of the big stories that really has not really been, you might have not heard about so much in the news, but there is a growing amount of new regulations, with Reg A+, along with some new recent regulations around crowdfunding and so forth that are now opening up the potential for firms to really leverage communities as opportunities of investing. And so there's just a lot, and there's even companies now that have 600,000 shareholders through new platforms like Core Connects and so forth. And so there's just a lot of opportunity there. And I think there's a great amount of investment opportunity as well for family offices. The other area I would say is small, medium-sized businesses, credit and lending. As we know, most of economic activity is by the SMB. And there hasn't been a lot of tools for them until recently. So there's a lot more capital tools coming into providing for small businesses, for freelancers, for even small e-commerce shops. There's a company such as Sellers Funding that just got a big amount of capital, is pursuing that. And there's also new regulations coming down with that for liberalizing the finders laws that I think are really going to open up. There's a business we're working on in that space, but there's just a lot of potential there. Another area is social investing. I think that is a big, you got two big worlds colliding with investing and with social media coming together in a world of so many new markets now with NFTs. You got event outcome trading and all sorts of things now that are really coming together. But how do we actually, when we have, Forbes talks about the rise of the retail army, and so, as more people get engaged, there are more platforms are interactive, they're educational. You have so much possibility and potentiality that starts to be increased. And so what we're looking at is like we're involved in a company called Story Trading that is actually providing a research layer in this pursuit. And then the last thing I would say, infrastructure. That's really a core area, of course, is and that's in the crypto, digital securities, and then a lot of the nuance areas that are the pipes and guts that make the financial system work. That basically is getting a whole facelift, as you will, right? And so in areas that we may not really think about, but in settlement and clearing and registry and all sorts of things. There was the first transaction from a Reg A+ to a blockchain recently by a company called Real Alpha Markets that we're involved with. And so there's just a lot of potential there, and that's another area we're excited about. So, and I think there's a lot of opportunities for family offices to be involved in this as well. So thank you very much.
Thanks, Joe. Those are really exciting areas, and I'm sure we'll get into them. And I'm excited to talk about the democratization as well. A little bit about me. I'm Manish Chitnis. At the beginning of this year, I launched a new startup myself called Sentinel AI, which is an investment platform with a vision to improve and democratize access to the very best investment analytics and tools that are leveraged by some of the top equity investors in the world, the sort of hedge funds and investors in the space.
Hey, Manish, I want to make sure we don't forget Chris.
Oh, sorry, I didn't see Chris join. I was just pinging him.
Great point.
Okay, all right, there we have it. Sorry, Chris. And we have Chris.
Made the mistake to actually go here.
Yeah. Great, thank you, Chris. I was worried that you weren't going to make it, so I was pinging you frantically earlier. Thank you, Chris. Chris is a managing partner at Sustany Capital, a blockchain venture fund. He analyzes the impact of technology on finance and society. He employs a first principles approach and scientific rigor to investments in technology, particularly those that are positioned to reshape the very foundations of the internet and global economic activity. His focus is on distributed Web 3.0 stack and decentralization. He's also a lecturer at a number of academic institutions on the topic and writes extensively about it. Hopefully you can check out his blog. Christian, we would love to learn more about you and what you're passionate about in this sort of disruptive area in fintech. I know you don't like the word fintech because of its window dressing of legacy models, but let's call it new financial technologies. Great to have you here, and if you can share a little bit about yourself, that'd be great.
Sure, yeah. We run a blockchain-focused venture fund out of Newport Beach, Southern California. We've been investing in those technologies since 2014. We have a very nuanced framework, like the moderator mentioned. When we say we're using a thesis-driven approach, in our case, that actually means we're using the scientific method, and we publish paper and share those for peer review. And we also look at every startup in this space kind of as an experiment on these ideas. So after doing this for quite a few years now, we have about 700-800 peer reviews of these ideas as an externality. We like to share the findings with academia. So we're largely responsible for Harvard's Fintech program. We share some standard setting organizations. And I think the important part is to understand that blockchain is a primitive within the actual development of the World Wide Web. What everybody here in the room is using today is not the World Wide Web. It's the commercial web, right? When you're on Google or something else, you're interacting just with one company. And that, in in principle is what the technology solves. I'm sure we can get into more of those details. Back to you.
Thank you, Chris. And now back to me. In terms of my background, I spent my career both in fin and tech. I'm a quantitative analyst. I've spent my career on the buy side of asset management. Previously, I was the chief data officer at a $6 billion long-short equity fund called Partner Fund Management. And I've led a lot of data frameworks and data development and analytic developments there. I've also spent some time in strategic due diligence for fund of funds. And prior to that, I spent my time as a convertibles analyst at a long-short event-oriented fund called Empyrean Capital in Southern California, which was started by a couple of veteran partners from Goldman. And where they pulled me out from, where I was with Goldman Sachs Principal Strategies, which was an internal proprietary trading arm of the company. And what I'm really excited about is the empowerment that data and data technology bring to the space. The access to information has really demystified many of the layers around finance, lowering costs, bringing innovation, removing rent-seeking behaviors, gaining profits, not from creating value, but just by being opaque. What we like to say in my old firm was that technology is now the arms dealer. You know, no industry can afford to kind of play with knives and swords in a world armed with these tech tools, these tech missiles. In finance, there have been a great many strides. Decentralization, as Chris mentioned, no trust architectures, payments, lending, undergoing very rapid innovations. And yet there are some areas, especially things that are not quite in the limelight, real estate operations, investment and trading operations, private investing, access for more investors. I think those things are still in the early innings. With Sentinel, I'm hoping to play a small part here in furthering this story along a little bit further, helping investors understand the implications, risks, options, and behaviors in their portfolio. And at that time, through that, helping them improve their performance. So that being said, I want to get right into this. We are all suffering from COVID fatigue. I'm sure all of us would have loved to join in person, but the world is getting more and more remote. But this certainly has been a defining moment for at least my investing career and for a lot of people. And as a reader of investing history, I know that such defining moments have accelerated change, technology adoption, economic activities, and sharply created and differentiated winners from losers. How has fintech been impacted by COVID, and where do you see fintech going in a post-COVID world? Tom, if I can start with you.
Sure. Well, Manish, I talked a little bit earlier about the acceleration in technology usage around the real estate transaction and relatively abrupt migration of where people live. The only way for those who are looking to establish relationships with home buyers and sellers to do that when you can't leave your house is online. And this has really pushed forward younger practitioners, whether they be loan officers or whether they be real estate agents, who just tend to be more capable, using technology and social media and so forth. I don't think these things are going to reverse. You're still going to have an older established real estate agent that owns a local market and gets all the deals, but the ability for new entrants to gain share quickly is really being powered by technology. We're also seeing a growth of tech-enabled brokerages, companies such as Compass and Redfin and Side and Place, and we're seeing them take more and more share from the traditional real estate brokerages and the franchises that lend their brands to them. And this isn't unlike what happened after the financial crisis, when immediately after the financial crisis, most loans went through banks, whereas now 60% of loans come through non-bank lenders. And speaking of go ahead.
Sorry, no, I just wanted to dig in a little bit. Is that because there are just more efficiencies in this new technologically driven companies? Like, where do you see the sort of real differentiator between what are old school legacy companies and sort of the newer companies? And are the legacy companies going to be, I mean, what you saw with Amazon and Walmart trying to now catch up, are you seeing that same trend with the sort of legacy providers here as well?
Yeah, for sure. There has been an unprecedented amount of investment coming from companies such as Remax and Realogy and Berkshire Hathaway Home Services into technology, whether that's building their own technology, acquiring businesses, or partnering with vendors like us to build out technology. They are moving faster than they've ever moved. Keller Williams has built their own native dashboard and operating system for their franchisees. So they're reacting very quickly. And the edge, though, really at this point has more to do with customer acquisition. There is money going into efficiencies around the transaction, whether that's the legal agreements around the real estate transaction, which are generally managed by the realtors, or maybe even more importantly, the mortgage. And mortgages in that space has seen a ton of investment in getting to what everybody calls the digital mortgage. If anybody's bought a house recently, they know that the mortgage is not digital. Parts of it are. We provide e-sign technologies. We provide loan origination software that really is the machine that manufactures a mortgage. But while I think most millennials and younger don't really understand why there's so much paper involved, there is still paper involved. There's lots of regulation, and the regulation is not uniform across the country. But you're seeing lots and lots of investment. You're seeing companies like Blend go from starting up to generating a modest amount of revenue and going public with a $4 billion valuation. So there's obviously huge expectations that we are going to get there, and that you're going to have more consolidation in terms of who's involved with these transactions, both in terms of larger shares going to bigger companies, both on the real estate brokerage side and the loan origination side, and also how much of that transaction you can be involved in. And this is where companies such as Zillow, believe that they can have a piece of more and more pieces of this massive transaction, purchasing the home, originating the mortgage, title insurance, home furnishings, all these things. This has sort of always been the goal, but never really been achievable. And we're seeing that really evolve, and the strategies really evolve. There are a number of new companies, some of which come from the Zillow Mafia alumni team. One in particular called Tomo that a friend of mine launched recently, and they're really tying together, the mortgage back to the home purchase, and trying to have one of their preferred real estate agents, be involved in that transaction. So they're getting, both pieces of it.
Great. And and this sort of change we've seen in a lot of different industries. From an investor standpoint, I'm personally familiar with the standstill that came to in-person due diligence. But on another angle, what was an interesting observation here was that some investors got a chance to take more meetings, not less, and they spent more time analyzing in each individual investment. Chris, what's your take on this change that's coming due to the COVID interruption, and how can some of these new technologies that you mentioned earlier benefit in a post-COVID world?
Yeah, really, what my previous panel member said is true. A lot of things have accelerated, really, because at the core, and I think that's largely still not understood, all of these legacy operations like banking and specifically government have a lot of technology debt. And you can simplify it to say they're using database solutions, and sometimes database solutions that date back to the 60s. So one example was in California, there were a lot of people, in order to get the money from the government, they still had to be sent checks at a cost of $3 per check. That took on average 2 weeks to arrive to those people. When simultaneously, we have the technology prerequisites to do instant settlement, instant payments already. It's just there's no adoption. But we got frantic calls to our fund helping with initiatives such as CalCon here in California to actually replace the food stamps program because of these inefficiencies. And maybe back to what you were saying earlier about real estate. So we're one of the largest investors, full disclosure, and Provenance Figure. They did the largest home loan securitization since the financial crisis last year on a blockchain-based solution. So that's a very exciting development and kind of at the core of the technologies that we're investing in finance. And like I touched on earlier, there was really no fintech before there were decentralized software solutions. That label was applied mostly to kind of window dressing solutions to legacy financial systems, which you can see, by the fact that it still will take you 3 days to get your money out of PayPal. But then more importantly, if you look at the overall statistics, all of these systems have actually become more extractive, not less. And as you guys know, technology should be deflationary. So the cost and efficiencies, cost should go down, efficiencies should go up. And what we've seen is actually the opposite.
Well, I mean, is that because technology is not deflationary, or because there's an oligopoly that's controlling pricing?
It's a combination of a couple of things, but mostly because at the end of the day, all of these new entrants in the space were forced to work with A, the legacy financial systems, and then B, within the confines of the legacy regulation regardless. So it's a combination of those two things.
So it's a regulatory oligopoly. Okay.
Yeah, in the United States, but the other part that's very important to understand is obviously, and this conflation is made on a daily basis, regulation addresses the behavior of people within a certain jurisdiction. The technologies that we focus on are all global in nature. We don't invest in lawyers, we don't invest in regulatory engagement, we invest in technologies. And technology is the solution to regulation at the end of the day. Anyway, I don't want to take up all the time.
So let's get a little bit farther in sort of broader areas of fintech innovation, some of the greenfield areas. Joe, what areas in fintech do you see as being ready for prime time? Where do you see innovation happening rapidly?
Yeah, great question. And I guess just to touch on the previous question, I just wanted to kind of, the two biggest things I seen COVID now really deal with was expanding the labor market massively in fintech. And then secondly, expanding the investor base for all variety of different markets, right? So now as far as what's really hot right now to get into, I would say that anything around like core infrastructure is really important. And that is really at the intersection of new regulatory changes. So this is where I focus a lot of time because it's fintech is multidimensional the way that it needs that you have to have the right ecosystem, the right kind of regulatory environment, the right type of technology It could be crypto or blockchain, it could be another, but at the end of the day, it needs to just get the transaction done, which is the most important thing. And having deep insights and all the mechanics of those areas is really important. Like I spoken earlier, I like online capital markets. I think that is going to be really revolutionary. I don't think people really quite understand the nature of that. We saw pieces of what could be possible when, a few years ago with the ICOs and how much money was being flooded into those markets, but they were not, legal. And so now you have a new, legal framework that is actually coming together with new technology pieced together where we can have all sorts of, it's the companies can now get funded by communities in a whole new way. And that can apply to real estate and all different types of projects in a way that hasn't been available before. And then you can incentivize people to refer investors now. That's soon going to happen, right? So all these different things are just going to explode. I mean, when you got a company that raised, $75 million with an investor base of over 600,000 investors, I mean, that is a whole new world that we're entering into, and it was all legal. And, and there's new technology platforms that can manage that. I mean, we weren't even able to, how can you get that many people on a conference call and think of all the paperwork? But now that's all, you're able to do that just with the snap of a finger. You can hit a button and send out your annual shareholder meeting to all those people. And so this is a whole new world that we're entering where people can give, a small amount of money can roll up. Now, what's also really interesting in here is that, the amount of time that a company can go from formation to some sort of liquidity event starts to get decreased. Okay, so it's the opposite. And I've been a backer of private companies. I'm behind Zambato, which is one of the largest kind of institutional ATS out there. Okay, but that's where companies are for now private for 15 years. But now you could start to provide some liquidity for companies where they can actually get have liquidity for investors after 3 or 4 years is what we're seeing. And so this makes it easier actually for like family offices can come and provide seed capital to kind of get the ball rolling. And then you can augment that with money from the community, okay? And then in a few years, you can get your money out. That 30% can come out at a Reg A plus, okay? And so that's really powerful. And we've seen some 12x, returns and so forth with some of the, this is kind of the field we're in right now. And it's very, very powerful. And I think it's just the amount of potential is just enormous. And this is across all assets classes, by the way, in all sectors. So, when you have digital securities and even crypto, we had some that are the first one going to crypto, from a Reg A plus to on the chain. And so there's just a variety of different interesting innovations all coming together at this particular place. So that's why I think it's very hot.
That's really exciting. Ravi, what about you? Do you see, where do you see in your areas are places where things are ready for prime time?
Yeah, absolutely. I think that the investment side of it, the democratization of investments, investing in any kind of business, whether it's public or private, has become a lot more prevalent and pretty much without any boundaries, right? We're talking about embedded finance now, where banking is becoming as a service, and essentially you'll see more open banking APIs. So obviously you heard about Robinhood going public this year. They have made investing a lot more easier than ever before. The newer generation, the Gen Zs, the millennials, are really looking at participating in these newer way of greenfield banking, where everything is digital, but although it's a lot looser regulation, but that's kind of where things are moving towards. Wealth tech, regulatory, technology side. There's also risk involved as well, and the risk are just because of there's loose regulation, compliance is very loose, and we're looking at also a lot of fraud. And because of rise of cryptocurrency and blockchain and the investment dollars that are going into it, there's also a cause for concern because of the money laundering and illegal businesses that could be participating in it. But other than that, the technology is definitely defining the frontier for this industry, and I see that this is continue to happen, and you'll see a lot more cross-industry with Apple getting into the this side of the business, Google as well, and Amazon and Uber are already in it. They're sort of the trendsetters, so a lot more of the partnerships, collaborations, and banking the unbanked, so to speak. So you'll see a lot more of these things as we continue to move forward.
Great, thank you. And in that context, Tom, I think we talked about how some of these things are already happening in sort of real estate. In that adoption cycle, has the train left the station already? Like, how people already sort of move? Is this already in vogue? Like, people know that this is just going to happen. Where in the cycle is the real estate tech? Are there greenfield areas in real estate still left?
Well, three areas that I think are getting a lot of focus. One is the evolution of this whole segment of iBuyers, and there are a few that went public via SPACs, and then Zillow has made that a big part of their business as well. And the concept here is that maybe a quarter of the market can be these market makers that are buying and holding and selling these homes. Much the same way you can trade in a used car, and in a much more click to buy Amazon or click to sell. So that is something that's being done, I'd say, at scale, but not being done at scale profitably. A second area is a lot more granular, but when you have a couple 100 million people visiting these property portals and searching on Google and doing all these things, you're just generating this huge top of funnel. And that's on the one hand welcome, but on the other hand, you have to have a way to move these leads downstream. And the first wave of this was just dump them on the practitioner. Good luck. Figure out who is really going to be one of the 5 million or 10 million buyers and sellers this year out of the hundreds of millions that contemplated it and filled out a form. So the second round was sort of giant call centers to manage this, and now we're seeing some significant AI get into the mix, where the first touch is AI, and when that breaks down, there's somebody offshore that is texting with the person, and when that breaks down, there's somebody in the US who gets on the phone with them in 5 or 10% of the cases. So there's really a lot of automation going into getting from, hey, I'm interested, to, hey, I'm buying a house, or I'm refinancing my house. The third area, which is probably the least mature, at least in terms of residential real estate, is crypto. You've got a couple of flavors of that. You've got home data such as valuations, verified valuations. We have a valuation business that recently signed on with a business called Chainlink to provide that data in a verified way to investors. You also have NFTs showing that ownership of the house is authenticated, and then the actual collateralization, the actual payment that can be made that way. This isn't happening in any I'd say material way today. I think a lot of people are thinking about it. And there's investment going into it. There is the SoFi founder who has a firm called Figure.com that is doing blockchain lending. But I think that's probably the least mature of those three areas that I described.
That's interesting. I was personally surprised when a friend of mine recently talked about it. He actually works for Fannie Mae, about how they're using alternative data and satellite imagery to figure out how many bathrooms are in houses to do proper valuations. Super interesting area. And I think getting to Chris, probably a lot of very interesting greenfield areas there. Can you comment a little bit about the fintech infrastructure changes, blockchain and Web 3.0? Help us understand that landscape a little bit better.
Sure. In the simplest way, so we never built the World Wide Web, but we built the commercial web. And the main drawback of the current web is largely dependent on database technologies. And database technologies need an operator. So that operator has full control over your data. So that could be your bank. So that's why your bank puts your money to sleep when they are not open. And that might include Google and Facebook, who have a treasure trove of data of you. So the difference of blockchain-based solutions is that they can convey data control from one person to the next. That's the main thing. Blockchains do not store things, do not use blockchains to store things. The larger point there is, and then I'll make an example to make this easier understandable. So probably many people have heard of things like central bank digital currencies, right? They're widely discussed, 84 nations around the planet discussing its implementation. The problem with them is none of them discuss the actual problems and or the reasons why people adopt cryptocurrencies today. So what's the main problem that all fiat has? It's losing purchasing power. So what we can already see, measure, and observe is that we have now wallets and centralized exchanges that pay 8% interest on a fiat peg. I assume your checking account doesn't do that. So, and the point there being is, with decentralized software solution, oftentimes people throw this term DeFi around as a shortcut for decentralized finance. I actually use it a little bit different. I use it as a definancialization of the actual productive economy. So whatever we are assigning today as GDP to financial services, I look at this as a penalty that we can abstract away. It should be somewhere below 1%. I don't know about you, but the last time I paid a convenience fee, I didn't find it convenient or productive.
I look at it more as friction in the system.
Exactly.
Right.
And so
DeFi getting rid of the friction.
Hence my earlier point, when you measure the legacy things that we called fintech, you see that they're all extractive. They actually added another layer of extraction on top of these services. So they, by coincidence, are actually the first that are going to be disrupted.
Thank you. No, that's super enlightening. In terms of something that might be interesting across, and I know we are coming up on time, it's a question for the entire panel. How can family offices get involved? How can family offices access some of these opportunities in the space? And where there are, and I think, Joe, let's start with you, given that you already talked about community-based financing and some of the democratization of this access. If you can elaborate a little bit about how the audience, about things that are relevant for the audience in terms of how they can access some of these opportunities. I think you're on mute.
There we go. Okay, great. Yeah, I think there's a lot of areas in alternative financing that is being accelerated and has more empowerment now with the new fintech platforms that family offices can get behind to kind of circumvent the banking system, and also with venture capital, as speaking around how we can. Capital could now be used as kind of like as a catalyst to raise additional money from communities now, and so that could go through a whole variety of not just good investments, but also social impact and a whole variety of different ways that could really be powerful. And family offices get their money back, and they can have much lower risk and shorter durations, which is ideally the sweet spot for a lot of capital deployment. So those are areas I think that are best suited for family offices at this point. Yeah.
Great. Ravi, your thoughts?
Right. Sorry, go ahead.
No, I just wanted to kind of get your thoughts on areas of opportunity and access for family offices, how they could access them, what your what your view was and how they can make it actionable.
Sure. I would say that family offices for the industry that myself or my colleague that were looking to raise capital for the water index fund is that we have a model that can essentially benefit from a small investor to a large investor because of how we're focused on the ESG aspect of it. And that alone is changing how the investment dynamics is going to happen over time. We have sort of created this model which will make every company aware of what they're doing in terms of their water usage as one, energy usage, reducing the carbon footprint, and operational risks that are involved. So I think family offices can benefit from a next generation investing, although there's not going to be a smooth transition. It'll take some time, but I see that over time, because Europe is much further ahead and China is as well, and US is a little behind when it comes to the climate and governance and the environmental impact, although Biden administration is doing a much better job of promoting the awareness and especially pushing the electric vehicle initiative, but there's still a lot to be done. The infrastructure is certainly one area that is ways behind. So I see a lot of opportunity for family offices in this area.
Great. And Chris, your thoughts on how family offices can make this actionable?
Yeah, so we spend most of our times talking to actual developers on average 3 to 4 developer calls every week. It's its own language. It's the emergence of a whole different ecosystem. So your best bet is interview a fund manager who's part of the actual ecosystem, because that's how this technology is being driven, right? We're building the web for the first time. It's open source communities. Most of the companies and projects you mentioned earlier, they are open source developments, but we were early participants in the graph and things of that nature. We're still developing all the primitives, decentralized storage, decentralized bandwidth, decentralized addressing right now. They already exist in the primitives, but most of the teams don't actually know where they fit in. So the best thing you can do is approach someone who's just dissecting the market and explaining it to you, because reality doesn't have an advertising budget. Whatever you find online is always motivated reasoning. It's always advertising, it's always messaging. It's not the reality. So we were excited about things like NFTs and preached that topic in April 2018. So that's when we started working with people that build these technologies. So that's what you want to do. So you want to educate yourself, but don't use public media, don't use the internet. Talk to someone who actually talks to developers on a daily basis and can explain the topic from first principles. We're raising a second right now. Our first is 80. We're raising another 100 million right now.
Typically, family offices are the investors? Or?
Yeah.
Okay.
Yeah.
Manish? Oh, sorry, the questions from the audience? Yep.
Do you have a lead family office?
We are the anchor for a fund of funds out of Europe. But we don't have a lead family office in that sense.
I got a bunch of contacts.
Okay. Sounds good.
Manish, I think we have to move on to the next panel. Any other question or wrap up statement you guys want to make? Manish.
No, thank you. Thank you for all of the panelists. I certainly learned a lot about different aspects of this ecosystem. Personally, it's a topic, as I said at the beginning, it's sort of near and dear to my heart, because I think access to information and access to the tools, like Chris was saying earlier, that that opacity has been the driver of a lot of intermediate layers that are simply rent-seeking, and I think opening up that access, I think, is going to lead to better outcomes. It's going to lead to a better environment for all investors, diversity of views, diversity of opinions, less crowding, more liquidity, I think there's a lot of things to take away, and that's what we're working on with my firm as well. Again, thank you to all of the panelists. Thanks for your attention to the audience, and thank you, Marty, for inviting us to speak here.